This video made possible by Killer Visual Strategies. Let us tell your story. Visit killervisualstrategies.com to learn more.
Welcome.
Thanks for
Thank
having
you.
us.
Can we start, and maybe we'll start over with you, Megan. Can you just give a quick overview of your background, your firm, and the types and stage of investments that you tend to focus on?
Sure. So Spark is a 15-year-old venture capital firm with offices in Boston, New York, and our largest in San Francisco. We originally started in early stage consumer, so Series A's of companies like Twitter, Tumblr, Oculus, Cruise. We subsequently, thanks for the water. We subsequently started up a second practice, our growth fund, which is where I sit. So we really invest along the life cycle of company development across all stages. So that's checks from 100K to 50 million, 100 million plus. We're generalists, so we do a lot of fintech, a lot of enterprise SaaS, and a lot of consumer investing. And we primarily invest in North America, Europe, and South America. Personally, I was at Kleiner Perkins beforehand for a couple of years, doing a mixture of early and late stage investing. Before that, I was the head of product at Square, where I oversaw hardware and software development. I started when the company was about 20 people. And before that, I was at Google for 8 years, in product for most of the time, focused on maps. And then before that, I was in school. I joined Google to work on the roadshow for the IPO as a nobody, as the person who collected gifts for Larry and Sergey.
All right, Dana.
So I'm Dana Settle, co-founder and partner with Greycroft, and started Greycroft about 13 years ago, based in LA and New York. I spent 10 years in Silicon Valley prior to that, working in venture and in a variety of startups as well. And when I moved to LA, I actually thought that I would join a venture fund, but there wasn't really a venture fund to join, and so I ended up starting one with two partners in New York, and have really grown in both those markets. We started as what we thought was just sort of a really focused small fund, focused mostly on the digital media industries. And turned out we started one of the first micro funds. It was a $75 million fund focused on kind of first round capital, so seed and Series A, and invested in a lot of the early successful media companies like Huffington Post, Maker Studios, Awesomeness TV, a number of companies in that area. And then we sort of grew with the opportunities, and we're currently managing about $1.5 billion across two different funds, so seed and early stage, and with our core fund, and then we have a growth fund that does sort of Series B and beyond. And we do a combination of B2B and B2C, split pretty evenly. And we invest across the country. We have some great investments actually in Seattle, Icertis being one that we're really excited about up here, and a number of others. And I'm originally from Seattle, so I love coming back. And like Megan, probably similar sectors, and really though with check sizes ranging from kind of $500,000 to about probably $35 million from our growth fund.
Thanks, Dana. Fun fact, Dana and I went to elementary school together.
True.
Gig Harbor, Washington. I am Hope Cochran. I'm a managing director at Madrona. I came to Madrona through being a serial CFO my entire career. I both started a company, and I always say that's the best way to get your first C title, is you just give it to yourself. It works quite well. So founded a company and then was a CFO at multiple companies. From there, two public companies, focused on really raising capital and taking companies public. I then went to the other side of the table, and now I'm on the Madrona side, investing in small companies, back to working with entrepreneurs at that early stage that I love. Madrona is here in Seattle. We're on our 7th fund. We invest primarily in the Pacific Northwest in seed and early stage companies. We also have an acceleration fund, and that's relatively new for Madrona, where we're looking for those companies that have found that product market fit, and we can then help them accelerate. We really focus on finding those super talented entrepreneurs and being with them in day one and going through their entire journey with them. And that's what we love to do, and we love being here in Seattle. I loved Jonathan's words earlier about how, or I think it was Craig's words actually, we were Seattle was the perfect fit, the perfect size. It's got an amazing amount of talent, and we love to foster that spirit of entrepreneurship here in the city.
So all three of you were operators before you got into venture, and I'm curious, what lens do you think that gives you, or sort of what empathy with the entrepreneurs you talk to and you work with?
I'll jump in there. Basically, I just think an entrepreneur has so much courage. Like, I have so much respect for the journey that they are embarking on. I know it firsthand about how hard it can be. I often say that if you look at like my LinkedIn profile, it looks like it was a beautiful straight line. And yet there were so many twists and turns, and there were so many times where I thought it was all going to fail. And an entrepreneur's journey will have those moments. And I just so empathize with them, and I know how hard it is. I know it can be lonely and tough, and I know that there's going to be things we don't expect. And I just want to be their partner through that journey.
Yeah, I think really all investors across all stages really look at the same 5 things when they're evaluating a company, and that's the entrepreneur, the product, the business, the market, and the deal at hand. What I think is unique to both stage and perhaps background is the order in which you prioritize those 5 things. And so at growth stage, it's actually very unusual to have someone who has an operating background. Most of my contemporaries, both at my own firm and within the larger industry, have banking backgrounds. And that's great, and we need them, and they're incredibly helpful and great investors. But where I think I have perhaps a different angle or different view is what I prioritize in those conversations with entrepreneurs. I tend to prioritize the product, given my product background, that makes sense, as well as sort of the entrepreneur themselves, and really lean on my partners to bring their own views so that we come to a shared point of view that is fitting for our fund.
So at the growth stage, one of the trends that we've seen throughout VCs are these very big rounds, and often rounds at a point in time when companies are still trying to figure out product at the same time they're given all this money to scale. And there's a number of places we can go with this, and I do want to talk about WeWork at some point today. But can we just talk about that trend, really, of like series or seed is the new Series A, and what impact this has had on entrepreneurs? And on top of that, really, do you think they're making mistakes because of getting so much money so early?
Yeah, I mean, I think it used to be, seeds were around funding the entrepreneurs. A was around funding the product. B was around the business. C was to, go scale up. And then D and beyond was either everything was really working or nothing was working. And what's happened is that we have a bit of an alphabet soup where the letters and the round sizes actually don't matter or make sense anymore. So we don't even talk about that internally. We really think about things on the continuum of risk. So if something is still risky, if there's still product market fit to be proved, we consider that a venture investment appropriate for our venture fund and our venture partners. If something has product market love and they're ready to scale up, even if pre-revenue, we're really looking for that customer, that user that is obsessive with the product, then that's a good fit for us on the growth side. But absolutely, we're seeing people raise tremendous amounts of capital even before they've found product market fit, and we've decided ultimately that we are not good sources or partners for those types of investments because we really do believe either in embracing the risk early on or funding that product market love that exists already.
Yeah, I mean, I would concur. I think it's interesting. We sort of talk about companies and if it's sort of like a cascade of miracles for them to work, and when it's cascade of miracles, it's very rare that it's actually going to happen. It does happen, but we try to at least eliminate some of the risks at the growth stage, and we certainly don't do it perfectly, but you have to thread the needle so perfectly if you're raising rounds based on just momentum and not actual product market fit, and not just product market fit, but actually having a business model that will work, so unit economics that work. And I would say that to address the WeWork point, that is changed sort of overnight. I mean, I think it really kind of came to a screeching halt where all of a sudden people were like, wait a minute, you mean WeWork doesn't work? The We company doesn't work, and that model doesn't work. And I think it just sort of all of a sudden is forcing people to take a real look behind the curtains on everything, and not just to assume that because something maybe works in one market. I think what we saw a lot of is models that were rolling out into multiple markets, and assuming that if something works in one market that it's going to work, and that's certainly not the case in every case. And so I think that there's just going to be a lot more scrutiny on the business models, not just product market fit going forward.
But doesn't it feel like every couple of years there's a venture capitalist who writes a big missive or a Medium post saying we're prioritizing growth over profits, and it's all going to change, and the pitchforks are coming, and it kind of slows down for a while, but then eases its way back? Like, do you think WeWork is really going to be a pivot point for the industry?
It's already started.
Yeah.
I mean, truly, in the last, how many days has it been? 14 days, something like that. I mean, I will say that we have always really focused on unit economics at the growth stage, and that's core to our overall sort of investment process and thesis. We're not investors in WeWork, and I'm not picking on them in particular, but that hasn't always been the case for all late-stage investors. But even in the market, not necessarily portfolio companies we have raising or companies that we're evaluating now, but in the ether, the conversations have changed quite a bit just around how much capital people are raising. Because it looks like there have been a few years where people have raised more capital than they know what to responsibly do with. And so that's really what's changing. It's not that these companies aren't great or aren't going to get funded. I just think it's the amount that they're going to raise and the timeliness with which they're going to raise it. I mean, we were on a treadmill of like A's and then B's 5 months later, and then your C was another 5 months after that. I mean, I think that entire process is going to draw out quite a bit, and I think that that's going to be a good thing for entrepreneurs, companies, investors, in the overall ecosystem.
I was just talking to one of our CEOs this morning, and this topic was very relevant. He had an interesting choice where he could raise a mega round, and he had created a budget that would support the mega round. But he was uncomfortable because of the valuation and the path that was leading them down. So he went through an exercise of seeing how much he could accomplish with half that amount, and realized just by knowing that he had that much money, he had waste in his plan. And when he was asked to come back and be scrappy and focus on unit economics, how much more efficient he was. And he actually ended up going a different path with that particular round and turning down the mega round to go down a more cash efficient, scrappy path. I think with the WeWork event that has happened, we go through these cycles where we're reminded that unit economics work. I go back to a long time ago when I was like in my early 20s, and my father was in a very traditional industry, and he looked at me and he goes, "Hope, don't you want to work for like a company that makes money someday?" Because we were in one of these cycles where everything was just about growth or how many people you're going to get to your website. And about 2 months later, everything crashed, and we were once again reminded that basic economics were really important. I think when you are running these companies, when you're investing in them, when you're the CFO in them, you have to remember that those corrections are going to happen, and if you didn't use good fundamental economics to begin with, you're going to get caught. And the worst thing you want to do is be caught in one of those cycles when you have to raise money. Never let yourself get there, so never let the economics go upside down.
Yeah, and I would just add, I think it's not, it's interesting because everybody sort of focuses on the companies and what's gone wrong with the companies, but it sort of comes from top down. And so, investors are throwing capital at entrepreneurs into rounds that, arguably don't make sense because they want to get their capital to work because so much money has been coming into the market. And I think that's where, as a founder, it is really hard. And I will say it firsthand. I've raised, $1.5 billion in a venture fund, and in our early stage fund, we can always raise more money than we want to bring in. And sometimes it's tempting. You're like, yeah, it's actually easier. Weirdly, in venture, it's easier to raise more money than less because there are more pools of capital that want to write big checks than pools of capital that want to write small checks. But we sort of come back to fundamentals and say, well, if we're overfunding companies, then they're going to get sort of lazy, and it does sort of come from the top down. And so that is something, as a founder, I think you really have to just be mindful and diligent that, it's your business at the end of the day. Like, you are going to be the person that is ultimately responsible, and that, you want to be making the right decisions for your business, not what venture capitalists or, others are telling you is the right thing.
So there was, the role of the investor and the role of SoftBank in kind of the WeWork debacle, but I think there's also the role of the board here. I mean, we're all on corporate boards, public and private. Hope, you've been a CFO, taken companies public twice. I mean, I don't know any other way to say it, but the corporate governance was a shit show, right? And like, how does that get through? Are investors and boards just have stars in their eyes with the stories and just not going back to the basics? And I hope that changes.
Yeah, I don't have a really good answer for you on how that happened. I'm on 3 public company boards. I'm on MongoDB, New Relic, and Hasbro. I love my board work, but I tell you, the governance is tight. And I don't know I clearly am a part of that. Like, I think that's important. And when you have a founder, like you have with WeWork and some of these other larger-than-life founders, that is a huge signal and a huge red flag. It just shows you how out of whack it gets and how that strong personality is controlling the board. The board has to step up and take control and understand that these governance tactics are important and that they're put in place. And it's a shame that it went this whole way without it being caught.
Let's shift to something positive. What sectors or areas of tech are you most excited about, and where do you have your focus right now? Is there any one or 2 areas you can name?
Well, on the growth side, we tend to be founder-driven. So we don't have a crystal ball. We don't sit in a conference room and guess about where any given industry is. We have spent a lot of time in fintech, have made a number of investments, a firm, Wealthfront, Fundbox, Marqeta, Plaid, Earnin, so forth. We think that there's tremendous opportunity within that sector. People are really reimagining what it means to have a bank and be a bank, and slicing off different pieces of the overall financial services market to build really compelling consumer brands. So we've been excited about that. We've also spent a lot of time on the consumer side, both in marketplaces, so we're investors in Rover, a company here locally, as well as Handshake, which is a recruiting marketplace focused on college students. And I would say in the last 2 years, we just did some math, I think we met with something like 67 direct-to-consumer brands, which are obviously very popular. We have had a really strong thesis around what makes a great direct-to-consumer brand and a good business for the long term. And out of that thesis, invested in companies like Glossier, Smile Direct Club, Warby, Mir, Lola, so forth. So that's some of the areas where we're spending time, but you never know what's going to walk in the door next.
Yeah, and I won't repeat all of the ones that Megan just said, because definitely we're spending time on those too, but the future of transportation is actually a big area that we are focused on, and it's sort of looking at how especially urban environments are evolving, and the transportation needs within those environments. It's you kind of can't just keep pushing cars into smaller and sort of more dense environments, and so we're really spending a lot of time on that. We also are spending a lot of time on health tech and wellness, and sort of looking at the whole wellness supply chain, because as the health industry sort of focuses more on preventive care and wellness, there is going to be more scrutiny on the products that are coming into the market from sort of the wellness perspective, and we think that it's a huge opportunity. So we've invested in a number of companies in that space, and then lastly, in SureTech, where again, we just look for markets where there's a lot of inefficiency, and I think that spells opportunity.
Yeah, Madrona, we really focus on this region, and so there's a lot of interesting sets of talent right here in this Seattle region. When I think of Seattle, I think of AI and ML and the deep expertise and how you can apply that to different software solutions. We also look at multi-sense applications. So we see folks, we got used to touching things, and now we're talking to things. And we've got Alexa here right in our own backyard. So what technologies are coming out that utilize those technologies? We would also look at DiFi, so that's the digital and the physical combined, and how we can bring that consumer experience with both a digital and a physical experience. We have a lot of e-commerce stuff here right in this town. And then of course we've got the big cloud platforms here right in Seattle. And so anything that's cloud native, we tend to see a lot of that as well.
So for many years, tech could do no wrong, and as we all know, there is a backlash now, and a very well covered in the media backlash against big tech, and looming potential regulation from a number of areas. Do you find this impacting either your lens on the companies you look at, or the ways entrepreneurs think about starting and scaling their businesses? Is it having an impact, those several layers down at the seed phase?
I mean, I don't really think so at the end of the day. I think big tech is being scrutinized in the same way that, historically large conglomerates have been scrutinized. And I think, when we invest in companies, we certainly hope when we're investing that they are companies that can become big, standalone, independent companies. It just so happens that a very significant percentage, probably 90 plus, of venture outcomes are actually M&A. So, it is a reality of our business that a lot of the exits for our companies will be, acquisitions by other companies. But it's not just big tech. I mean, it's lots of other companies. And so I don't think that it's having an impact on the way that we're sort of thinking about investing at the earliest stages.
I will say that there's a ribbon or a narrative that I've seen in pitches recently over the last year, let's say, is there's been more scrutiny around big tech. That is, when you talk about barriers to entry and why can't, Facebook or Google or whoever do what you're doing, people will say, oh, consumers don't trust them. Consumers don't want to use them as their identity platform. Consumers wouldn't want them to have this kind of information. Now, we can argue whether or not that's true, but that has become part of the narrative for certain companies. And I will say, in a very, very positive way, there's a downstream effect where some of the regulation has actually spun up new types of companies, for example, GDPR, that are helping companies, both in tech and everywhere else, comply, that are really actually interesting SaaS businesses. So that's sort of many, many layers downstream, but that's really the only sort of implication that we've seen so far, at least in the early stage private markets.
I was talking at lunch today to a speaker that's talking later today from the FTC, and he talked about companies that grow with the sole purpose of wanting to be acquired by a Google or an Amazon. And he was curious from the VC perspective, will we see less of that? And kind of read the subtext of, who's asking. This might be something potentially they're looking at. Do you think exit strategies will change, or plans for exit strategies will change if there's regulation?
I don't think it changes. I think that when we invest in a company, we want to know that it can be a standalone large company on its own. We're not thinking, is there an exit strategy with one of these larger companies? Now, as Dana pointed out, that is often the outcome, but we certainly would not have any sort of strategy or scheme that is where we're headed. When I think about the world of big tech, I do think there is such an important role for these independent companies, because I think other companies who buy this technology need to be able to work across the different cloud platforms or across the different tech companies. And so it is important that we have companies that are independent to these larger groups as well, and that they have a strong hold in the industry.
All right, new subject. I want to state the obvious. We are a panel of all women up here in venture capital. Thank you, GeekWire, for staffing a panel this way, because this is actually exceptionally rare. 71% of VC firms today operate without a single woman investor. Put another way, only 11% of VCs are women. I don't have the stats on ethnic diversity, but I know it's even far worse. Venture capital is a white male business. Answer, I think, the obvious question here is the lack of diversity in venture. What impact does that have on the companies that are funded?
I mean, there's definitely unconscious bias, right? I mean, it's just, it exists. I mean, anybody that says it doesn't is crazy. So, you know, I do think it's really important that the allocators of capital are diverse. I mean, I do think that is how things ultimately change. And Megan more so than I, but we've both been involved with a group called All Raise, which is doing a lot to try and bring more women into the venture capital business. And, you know, for myself, as a founder of a venture fund, I mean, we have, you know, another female partner. We have a number of, you know, women on our investment team. We have a very diverse investment team, period. And our investments tend to, you know, the founders tend to be more diverse as a result of that. Actually, our first IPO was this year. It was a female-founded company called The Real. And so, and I will say, I mean, when, you know, being at NASDAQ and you know, sitting at the breakfast in the morning, the president of NASDAQ was a woman, teared up as she introduced Julie, and you know, sort of looking around the room, said, this is the most, first of all, it's the most people that have ever come to an IPO breakfast. Second of all, it's the most diverse. Third, it's the best dressed, because it was the real. Nice. But she said, you know, there are only 20 female CEOs on NASDAQ of 3,000 companies. And that was like, it was such a strange moment for me to kind of be there. And actually, a lot of the investors in the Real, from early days all the way through, were all female general partners. And it just made, you know, it just sort of hit home as to how real that is, and the difference that we can make if we actually do bring intentionally more diverse you know, investors into venture funds, onto boards, which I think is a great opportunity, you know, across the board. Anyway, I'll be quiet and let Megan talk.
No, I mean, I think first off, I give a lot of credit to GeekWire, not GeekWire, but GeekWire, for this panel, even just the headline, the VC view, because frankly, if it had been women in VC, I would have declined. I don't do women in VC panels anymore, because I think that only is putting women more and more into a box. So a lot of props for that. Yes, I mean, we are doing work with All Raise to try and change the lack of diversity and representation in venture capital. I think the implications, as you mentioned, are fairly obvious. If the people who are deploying capital do not reflect sort of the broader world, that will impact the types of businesses that are ultimately funded and scaled over time. We all know the stats around women, discretionary spend, household income. We have a tremendous number of opportunities and companies to build for a customer base that, quite frankly, perhaps you don't have, you're not as in touch with necessarily if you don't have that same experience. So I do think that, you know, as VCs, we all bring our own perspective, our own background, our own experience to bear when we make an investment. Saying that we don't and that we're 100% objective is just impossible. And so if you don't have a variety and diversity in your background, it's really going to have, I think, severe implications for the types of businesses that get built over time, and frankly, where wealth ends up being generated.
Yeah, and I don't know that I have all that much more to add, except for just emphasizing that word intentionality, Dana, that you used. You know, throughout my career, I've always been in male-dominated industries and felt that if I work hard and fight the good fight, it'll all resolve itself. And I did that up through my last role, which was the CFO of King Digital, which is the maker of Candy Crush. And I really tried in that role to bring on women when I could, but I didn't put myself out there that much. And then I joined the Hasbro board. And what I saw at Hasbro is they actually made it part of their KPIs. They put a huge company effort into creating diversity on their board and their executive ranks and all the way through the company. And it was the only place I saw that it actually happened. And they were incredibly intentional about it. And it really made me grow up and really realize I needed to put myself out there and speak about it and talk about it and make a huge effort, because the unconscious bias is very real, and you can't get over it by just trying to fight the good fight. You really have to put some stakes in the ground, you have to measure it, and you have to make a substantial change. You know, what I see in the VC world is we tend to like to invest in things that we understand or that we get, or maybe we are the consumer of. And that is the unconscious bias, right? Like if it's a group of white men, they might not understand the product that's coming in the door from the female founder. And therefore, it's just hard to take that leap and invest in. So we do need more diversity at our ranks, and it needs to be very intentionally changed.
So for anyone in the audience who maybe is an operator today, woman or man, who says, maybe I'd like to get into venture at some point, what advice would you give?
So a couple things. One, start sharing your point of view about companies, about markets, about anything that really interests you, and to do so in a public way. Yes, this probably means tweeting and Medium posts, but that is really a fast track to become somebody who's known. And as we talked about, as it relates to diversity, a lot of our business is predicated on networks and networking. So that's one tip. Second, if you have discretionary spend, if you have been at a company and made a bunch of money, lucky you, and start doing some angel investing, because that really puts you on the map, even more so than the thought leadership is really putting very small check. I mean, it does not have to be a lot, but small checks behind businesses and entrepreneurs that you think are exciting. Because again, that puts you on the cap table, that gets you a seat at the table to have sort of broader conversations with the venture capital industry. What else would you guys recommend on that?
I mean, I would absolutely encourage, especially, I mean, if you've been a C-level in particular in a company and, and a founder, I mean, go on a private board or go on, with some venture capitalists that you'd like to get to know and, sort of identify those companies and reach out. I mean, we're always looking for really great board members operating, people either in operating roles or, who have just exited companies. So I think that's a really good way to get to know, venture capitalists too, and for them to sort of to understand how you would work together. So,
what are you telling your companies about the potential of a recession and how they should think about this in their planning?
Well, I have a lot of scars in this area. I'll speak of it in terms of the seat of the CFO as well as being an investor. I think you always have to make sure your business choices are incredibly rational and you don't get caught up in any hype that you're in. I also think there's a lot of practical elements, like make sure when you sign that real estate lease, it's not a 7-year commitment. Like it's a shorter term commitment. You need to be nimble. You need to be able to change things on a dime. I almost killed a company by signing a long-term lease, so I'm revealing one of my trials and tribulations right there. But I also take a really different look on overhiring. And it doesn't feel like overhiring at the time. It feels like you desperately need all these people. I love walking into an office and the office is crowded and everyone's really busy, right? Like that's a good feeling versus you've just entered into a lease where there's way too much space and people have idle time. That is not a good vibe. You always want to be on the edge of being over busy and overcrowded. So you're utilizing every dollar really efficiently. So, I think the biggest thing is not getting caught up in the hype because it's really easy to get caught up in the hype. Not signing things that commit you to things you can't get out of, and being really careful about the growth and making sure that the activity in your company or your firm really support that level of growth.
Yeah, perhaps we're old-fashioned, but there isn't anything new we've necessarily been advising our companies. We've always had a mantra around focusing on unit economics, focusing on efficiency, whether you're a consumer business or a SaaS business, and part of that is definitely around hiring, and understanding, if forced, how could you get to profitability? How long would it take, and do you have enough money in the bank to get there? So those are really the three things, but again, that's not so much a reaction to any potential recession. It's really just what we believe responsible businesses should be doing, particularly at growth stage.
Yeah, and I mean, I think just in general, again, just like healthy practices. I mean, by the way, all of this stuff is so easy to say, but hard to do when you have, sort of boards and investors pushing you to go fast. I mean, it is much harder to do than we're just saying, but I really believe in, every quarter sort of looking around and pushing yourself hard, pushing the companies hard to see if there are, if there are underperformers and really moving on from people. It's hard to do, but if you just keep that as a good practice and doing it, you won't find yourself in a bloated position. And again, I understand how hard that is to do when you're running super fast. So sort of the last thing you want to do is sort of look to make cuts. But if you just do it with some regularity, then it's also not like, oh my gosh, we've just hit a recession, now everybody has to go. And so it sort of becomes just more part of the process.
Let me ask an IPO question, and then I'm going to open it up if there are any questions in the room. So we work in some of the environment this summer. Has it put a damper on the IPO market? What are you advising your portfolio companies now? How to think about this? And maybe I hope even your perspective as a CFO who's done this twice.
Yeah, when you said, you caught me on the what are you advising your companies to do now? Because I'm certainly not advising them to do anything differently. IPO windows open and IPO windows shut. If you have a company that is feeling like it's ready, you get ready. And then you go through that window when it opens. And I feel like in my career, I've always been a state of readiness. And there's been moments where I've been ready for a really long time, and there's moments where I had to get ready in a day. So it is not uncommon for IPO windows to shut. And I will say, I don't feel like it's shut right now. I feel like we had some irrationality that happened, and people are observing that and thinking about it, but I don't feel like the window is shut. So I'm not quite sure there's any different advice I give, except for it's about the health of your own company. Are you ready for that experience? Are you ready to be public? And then you get ready and you go when it's a good time for the markets.
Any thoughts on direct listings versus traditional? I know this is a big topic right now.
It is quite a hot topic right now. I was at the direct listing symposium or summit or whatnot last week, where it was really around educating, I think, venture capitals more broadly just about the differences between the two processes. Look, we have an N of 2. We have Spotify and Slack, and they've certainly paved the way for a new type of vehicle for going public, and I don't think the door is going to close on that now. So I think that we'll continue to see more and more direct listings, but I think what's really important for people to be aware of and acknowledge is that there is no one-size-fits-all process, and that there are some requirements of a direct listing that don't really apply to all companies. Namely, you can't raise capital as part of it, which is a big part of a public offering for a lot of companies.
Yeah, I think with the direct listing thing, I'm not quite sure I love the direct listing, and it's yet to be proven because there's only been 2 of them, as you say. But I hate the IPO process. So I love the fact that someone's trying to disrupt it. I mean, in what other scenario do you take something out, and if it pops 20 to 30%, that's a positive? Like, no. I mean, that just means you badly priced it. So if we were to go sell our product at a 20% discount, would we think that was a good idea? No. So, like, this morning I was in a conversation that said we've had X amount of successful IPOs this year. Well, successful IPO meant that it went up 20% the day it listed. Like, I don't know why that's a success. All that's doing is feeding the engine of the banks make money from the Fidelities and the Wellingtons and whatnot. There's just a definite inherent conflict of interest in that process.
Sneakers and IPOs.
Yeah, it needs to be changed, but I'm not quite sure direct listing is the solution yet, but I love the fact that someone's out there trying to disrupt it.
The one thing I would just, going back to sort of what to advise companies, I mean, again, just sort of like the good housekeeping thing, we tell our companies, even in the early stage, like, and it's crazy to think about, but like, always be prepared for an exit. Like, and if you can kind of have that mentality of like, always have a data room ready, like always have your financials in great shape, like maybe don't do a full audit your first couple of years, but do it as soon as you're at, I don't know exactly what the right scale is, but 20 million in revenue. I mean, just good housekeeping. And if you're always prepared, then whether, an acquisition comes out of the, sort of woodwork that's something you decide to take, you're in great shape. And if you decide to go public and the window is open, then you're in great shape. And I think a lot of those things sort of, especially if you're at the growth stage, I would absolutely, like, if there's one thing to do, like, go back and be prepared. But even if you started at the early stage, it's not so hard to like go back and retrofit.
That's great advice. I think we have time for one, maybe two, if it's short question. Is there any in the audience? I can't see very well. I think I see something here. Yeah, walk on up.
How you all doing? My name is Roble Muse. I'm an author of the book On Silicon Valley, and I like the discussion earlier talking about not wanting to raise too much money and being careful with the metrics. I also have another question. You talked about diversity in terms of adding partners in your ranks to improve, to address kind of the subconscious bias issue. What are your thoughts about VCs that are primarily focused on maybe women-only entrepreneurs and maybe African-American-only entrepreneurs? I had a question. I don't feel it's a sustainable model from a VC perspective, because you need to look at a ton of investments and pick a few, and maybe you're looking at segments as opposed to the demographic of the entrepreneur. What are your thoughts about
So your question's around VCs who focus on underrepresented groups. Is that
yeah,
a good idea? Does it work?
I mean, we are first and foremost investors, and we invest capital on behalf of, public pension plans and, endowments, and so we are tasked with making good returns for our investors, for our limited partners, and so that is first and foremost what we do. And so, I think if we're not backing great companies that, don't have great returns, we won't continue to be in business. And so, I think that has to be the lens for venture capital, generally speaking. But I think what I'm saying, at least, and I think we all are, is like, there are many, there are a lot more great founders and great companies that are out there than necessarily sort of might reach through the network that exists today. And I think that's what we're trying to expand. That's what I'm saying, at least, not just to focus on, female founders or other underrepresented founders.
Yeah, I mean, that's how we think about it. But look, there are VC firms that focus on real estate tech in Brazil. I mean, you can get very, very focused funds, and they can do really well because they turn over every stone and every rock and meet every company and know everything about a certain market. I'm not sure that I agree that there's not an opportunity for there to be venture capital firms that are focused on specific constituents, whether it's, I think you mentioned African Americans or women. I think that there's probably tremendous opportunity, frankly, to make good investments in those verticals if you are taking the approach of a very verticalized venture capital fund. Just so happens that the three of us actually are much more generalists.
Great. We have 1 minute left. Unfortunately, I don't have time for more audience questions, but can we just end on, can you name, is there one entrepreneur you've worked with who has impacted you the most in a very quick why?
Well, for me, Julie Wainwright, the CEO of the Real, founder CEO of the Real. I mean, she's an incredible entrepreneur. This was her, third or fourth company, and when she also was the CEO of Pets.com, and which was sort of the .com failure. And when she, was raising money, she had to fight through that every single time she raised money, and and she is an amazing entrepreneur and so inspiring, and she's just, a great leader in every sense. But, she just fought through it with grace, and when people would ask her the question, she'd say, yeah, that was 20 years ago,
So move on, next.
Move on.
Yeah.
I'm going to go with a sappy one, and I'm going to say my brother. Matt Flannery, he was the founder of Kiva, which was a not-for-profit that does microlending all over the world. And now he felt frustrated with that because the not-for-profit structure wasn't allowing him really to reach people directly. And so now he's running a for-profit company called Branch, which is doing a very similar thing. And just his ability to take a social impact but actually make it very profitable is incredibly impressive. And I've enjoyed kind of being his sister and working alongside him in that.
It's very hard to choose amongst entrepreneurs, for sure. I do think, probably for me, it's Stuart Butterfield. I invested in Slack a couple times, and They recently went public over the summer, and so for me personally, and from a professional standpoint, as someone who's been an investor for about 5 years, that was the first time I felt like, oh, maybe I'm getting the hang of this thing. To your point about operators moving into venture capital, one of the biggest differences is you don't get any feedback on if you're any good at anything for a long time. So for me personally, that was gratifying.
Thank you all. This was great.